Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the EIA and we're going to do an overview and really kind of hone in on the different refined products. And we're going to change it up a little bit because we're going to separate out some shows. So following on this, we'll have something on consumer trends, economics, and then OPEC and geopolitical, just to give things a bit more time and really hone in on things that are important for specific topics. So now let's really dive into the crude stock. So we had a nice draw, which was, which came out with the API. We knew there was going to be something just because, as we said last week, imports were going to come down. You're going to get a little bit of an increase in utilization rates. You're going to get a small increase in oil exports. So it's not really crazy to think that we're going to have a draw of this size. So right now we had a draw of about 7.37 million barrels a day with, production, according to the EIA, relatively flat. Now we're still at about 10.8, 10.9. And now we thought things were going to adjust a little bit, but then the Dakota Access Pipeline got a reprieve from a judge, so they're not going to have to shut down while some of this goes through the court system. So some of that Bakken flow that might have been hindered, won't be hindered now. But again, there's so much spare capacity right now, just given where capacity oil production sits. There's more than enough to really go into a pipe and or rail. It just makes things a little bit easier. So some of those flows will continue. Draws should continue just because there's going to continue to be a breakdown between imports, exports. So we expect another draw next week. But one thing that we really need to consider is, where are the draws happening and really what is driving this? So when we look at, the total inventory, again, we include the SPR. You can see that we're still at seasonally adjusted all-time highs going back to 1991. Obviously we had another period where it was higher, but again, it's just in terms of where we are that we should be trending lower. And this is a nice step in that right direction. But again, we're still not seeing these drawdowns. If we continue to see 7 million barrels a day, we'll start to, whittle through some of this. But there's something that's going to kind of be a hindrance to that, which is the boats that are sitting in the Gulf of Mexico. So the other thing which we always continue to push is really looking at Pad 3. Because Pad 3 is where the exports are leaving the coast, you have the imports coming in, and this was really where the draw this week last week was really driven. Pad 3 was down about 7 million barrels. So you kind of get an idea that the biggest draws were in Pad 5, which is the West Coast, and then Pad 3, which is the Gulf of Mexico. So Pad 5 is going to have its own issues, which we'll touch on, but Pad 3 is going to be that timing. So we should have imports start to creep higher, but again, it's going to be a timing delay as to when do the refiners want to pull them in and try to change their mix, because feedstock is going to be paramount as we go forward through the remainder of the year. So when we look at kind of where the imports, runs, implied demand sit, you can see that this is the imports that we were talking about. So when you see Pad 3, we were down about 1.6 million barrels a day in terms of imports coming into Pad 3. Pad 2 was up. That's more Canadian crude coming down, and Pad 5 is going to kind of be that that in between. Pad 3 is really where we're going to see, how these things are really moving, adjusting, and that's why we're going to keep looking at that and really focus in on, okay, well, when should these imports start coming? When is that going to start to increase and reverse? Runs, we had a small increase, again, about 60 basis points. It was really driven Pad 2, 4 and 5, where Pad 3 had a decent step down. Now, as Pad 3 starts to ramp back up, because we had some crackers coming down, we had some adjustments, you're going to have that marriage because, and this is not to get too complicated, but there's different types of oil. There's all these different types of oil, and a refiner has to optimize that mix for what the process is going to be and what they want to create. So right now, the goal is make gasoline, minimize your diesel, and have the flexibility for that jet fuel. So right here, by creating that gasoline, we're going to see this adjustment, which is why you have some of the product sitting offshore. When is it going to come in? When is it going to? And it's really going to be married to where are these flows coming from. And that's why when we look at implied demand, you're going to get some look at, okay, well, when are they going to ramp? When are they going to adjust? And you can see based on the applied demand, distillate continued to see that recovery, which is, again, positive from an economic perspective, because, this is what's being pushed into the rail, trucks, the whole industrial side. But gasoline continued to weaken, which is something that we talked about last week. And that's why we think that there's going to be a continuation of weakness, just because you have renewed issues in terms of COVID, lockdowns, and some key driving areas. So just to dive into where are these builds. So right now, that previous peak that we had at the end of May, that was when that Saudi flotilla showed up. So right now we're about 137,000 barrels away from that spike. So we're really close, and if you can just see that off of a seasonal adjusted, we're at all-time highs, and that's why even though there's some positive where you're getting a lot of support in the oil price, this is going to continue to be something that's going to act as a cap to where we can really see some of these prices go, because we have a lot of that oil sitting offshore. And then to just consider, where are imports on a seasonally adjusted basis, you can see that we're back net now below seasonal averages. And again, it's all timing. Like, this is something that will start to rally. But again, we're not going to see this massive spike just because you have some refiners that are still down. We're still only operating at 78%, which, we still think that we'll average about 75 through the end of the summer. So we'll have a little bit of a normalization as things come down. And that's why those imports are going to continue to adjust, specifically into PADD 3. But they're just going to have to play with that refiner mix to really marry how do we minimize losses and create a product where we're not getting killed while trying to maximize our return by playing both the crude side as well as the product side. And that's why when we look at refinery utilization rates, you can see that we're still well below where we should be for this time of year. 78% is again, we're well below where, or right where Harvey was, if you want to think about where the disruption. And again, you can see that we had this nice rally, and now we're starting to kind of level off. And that's why we think that's, 75, 78%, and we're going to start to see some of that come off. But again, we're also seeing some recovery, just depending on where you are, in gasoline demand. So it's going to be spits and starts as to when do they come up, when do they come down, and when do they try to play with some of their numbers. And that's why PADD 5 or the West Coast, we think we'll start to see some reductions. Now, in the next side, we're going to go into, where are refined products and really what's happening with distillate gasoline in a bit more color. Now, as we talk about diving a little bit deeper into the specific refined products, we have to really kick off with distillate. So distillate had a small draw. It was more than expected because there was an expectation of having a build. But again, we have to look at where do we sit in terms of all-time highs. We're still at seasonally adjusted all-time highs. And then again, to get to these levels, we have to go back to 1983. So you still see that there are these builds that remain sticky within our storage, which is why we're starting to see a little bit more exports, because you're starting to see some deals made where some of these exports are leaving our coast. They're going into Europe as well as Latin America. So we're giving a price concession to keep some of this stuff moving. But at the same time, you are seeing a little bit of a recovery in places like France and Germany. So they are going to need more, especially as some of the Indian and other Asian flow starts to kind of pare back. So there's a little bit more of a normalization, specifically coming out of the US. But when you make gasoline, you're inherently going to have to make distillate. When you make distillate, typically for every 1 barrel of diesel, you make 2 barrels of gasoline. So there's always going to be kind of that marriage. And you're going to try to work of how do we minimize one, maximize the other, increase quality. So these are things that are why we always talk about crude quality, imports versus domestic, because it's always a matter of how do we create the best barrel at the lowest cost to try to maximize profit, which is obviously hard to come by given where crack spreads currently are. So as you can see, we had a small draw. We think that we're going to kind of continue to see something relatively flat. And the reason why we say that is when we look at, the demand remains around the 5-year average. We don't really think there's any reason to send it higher or send it lower, just because this is a calculated number. So even if we have a little bit less demand in the US, we still have a little bit more demand abroad. So you're starting to see kind of these different shifts. And the shifts are always going to continue. Like right now, something just came across that the East Coast is receiving its first North Sea blend. And again, like refiners are going to do everything they can to try to maximize. And it's always going to be, what do people want? Where can I export? What is my percentage in terms of margin? And that's why crude moves are always going to be a little weird right now as OPEC and things kind of normalize. And when we talk about distillate, we always look at, where's rail traffic, where are things going? Against 2019, again, we were down another 12.7%, week on week. And, going through year to date, we're down about 15.8%. And the reason why that's problematic is just because 2019 should be easier comps. Now, given we have COVID, we have all these issues, but 2019 should be easier. So these are still an issue in terms of where the demand is. And you can see a lot of the slowdowns is coming in some of those key economic industrial areas. So while we're starting to see a little bit more of a normalization as more diesel goes into trucking, more diesel goes into the road side, we're still not seeing the same demand on the rail and shipping side. Just some anecdotal components on shipping because, LA and California gave some TEU numbers. We were down about 11% to 12% in terms of just containers moving off and on, and just in terms of, counters. So we still see this incredible slowdown on a shipping side, which is being reverberated through China, which even though they had slightly better numbers, they're still down 3.3% year on year, to this point. Japan, South Korea continue to struggle. So these are things where when you consider where is diesel overall, you have to consider where are the rails, where are the trucks, where are the ships. And while trucking remains relatively strong, rail and shipping remains lackluster, which is why there's that kind of middle ground. And then when we look at gasoline, we have to consider the consumer, which we'll go into more depth later on. The consumer stock had a nice draw. It was at about 3.1 million. And you're going to start to see a little bit of an adjustment because Pad 1 or the East Coast is taking in more imports this last week and this week from the Europe. You're going to see a little bit of an adjustment, but the Pad 5 one is interesting because that's Pad 5 again being the West Coast, because you had a new resurgence of COVID in specific areas, some new lockdowns. Not that anyone is really going to the museum or movie theater or other, but even if you wanted to, you can't now. So there's some adjustments, and people are starting to panic a little bit, like maybe they adjust their patterns. So that's something that we're going to see a build kind of continue. And, you're seeing that those draws come in. We're still at all-time highs, seasonally adjusted back to 1991. But again, you should get that trend lower. The bigger issue is the gas buddy data. So the gas buddy data, the week from 7/15 to 7/11, and then comparing that to the week of 6/28 to July 4th, we saw gasoline demand fall about 4.9%. So this is the bigger issue. You're starting to see the trend go the wrong way as we come through the end of the summer. So that's one of the things where we think some of these draws are going to continue to draw down, but just not at the same pace as people start to readjust and you start to see that softness in demand. And that's why when we look at the gasoline demand, going back to February, you can see the trend starting to roll over. Now, again, we're not going to roll back over to where we were in March, April, but you're starting to see that normalization as people start to adjust. Work from home is going to continue. You have people shopping a little bit differently. Like you can see, we didn't achieve that higher high. Instead, there was a lower high, and that's why we're starting to see that roll over, which is something that we think is going to be relatively sticky as we go through the remainder of the summer and through the rest of the year. And again, even when we start taking the calculated numbers, looking at different things, we assume that we're going to average about 8.5 million. We're at about 8.6, but you saw where we kind of rolled over and we started to come back down. Just given, the holiday season is over, people aren't traveling as much, and you're starting to see some of these renewed lockdowns in Pennsylvania now, New York, New Jersey, Florida, Texas, Arizona. Now Tennessee is spiking. You're starting to see some of these adjustments. Now, the spikes are natural. Like, we're always going to have these move through, but people are just going to change their patterns of behavior, and that's really going to always reflect within that driving data. But when we talk about driving data, we also have to consider what is jet fuel demand. So jet fuel demand had a big increase, and it should be expected, because if you look at what Delta has said, American, United, they're adding back flights in August. So you have to start getting that fuel to where it needs to be prior to having those planes. So if you bring back a flight August 1st, you need to make sure you have enough jet fuel to fill that plane. So you're going to start to see that pull come a little bit earlier. And that's what is reflected here, which is, again, a great positive. It pulls more away from distillate, because we talked about when a lot of this started, how kerosene can go into distillate or gasoline. So you're starting to see that come back out, which is a nice positive in terms of where things are. Again, this is something that's going to normalize, just because Delta initially said 1,000 flights, now it's 500. So you're starting to see things adjust, and the adjustment from 1,000 to 500 was really because of this resurgence of COVID. So while the demand won't come back to where it was, it will come back off of this high. And that's when we really have to look in and turn to exports, because when we look at exports, we have to consider where things are moving. We talked about how gasoline had a nice little pop. Distillate remains well above where it has been on a seasonal level. And these are things that will start to continue to kind of normalize. Gasoline, we think, comes down just based on where Latin America is. Again, timing delays, you can't get all this stuff out at the same time. We thought exports were actually going to be up a little bit more, and you can see that there is only an increase of 156,000 barrels a day. Again, that's timing. So we can see the boats, we can see the movements, but when they get that classification, where they are is always going to be a matter of rolling 4-week averages, which is why we always want to look at year over year, 5-year average, to kind of get an idea of where do things normally fit. Because, based on what we're seeing, exports should continue to trend higher, while imports continue to trend not as low as they are, but, well off of where they should be on a year-over-year basis, which is going to keep some of those builds. Then when you look at, where gasoline exports are, again, we're still kind of sucking around that 5-year average. We think you're going to get that pullback, but again, it's going to be a pullback kind of around that 5-year, which is going to be good for just, trying to manage where our storage is. And these are things that are going to continue to kind of waffle as we go through the end of the summer. The other one is really that distillate side, because the distillate exports, we on a seasonally adjusted level, we're right near this new high going back to 2011, and it's good to see, and it's something that should continue over the next week or two, but it should pull back into closer to the range and kind of marry through that 5-year average as we go through the remainder of the year. As you have Europe that has taken the cargoes, what are the deals going to be? So these are things that we're going to continue to look at and really assess. What is pricing? Crack spreads are down. So, which it shouldn't be surprising as you have crude prices up. Demand still hasn't kind of been there. And the OPEC meeting happened, which we'll talk about in another episode. Now, thanks again for watching. We're going to change things up a little bit, and we're going to have the OPEC Plus show come out on Thursday. And then we're going to add a new show called The Economy, where we're going to really marry the consumer trends and that macroeconomic data that is relevant for every industry. And then we're going to wrap up, as always, with our favorite, the Primary Vision Frac Spread Count on Friday. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.